We are really happy today that we have Haoxiang Zhu. He's a Gordon Biller Professor of Management and Finance at the MIT Sloan School of Management, and he has been doing quite a bit of work in finance, particularly asset pricing, and most recently has been working on issues like fintech credit and also digital currency in the digital economy. And his co-author, Rod Garrett, he is now the Maxwell and Mary Pellish Chair in Economics at the University of California in Santa Barbara. And he has actually, also very well known in the policy circle as he has been the technical advisor to the BIS, Bank for International Settlements, and the research advisor at the Bank of England. I guess you are also related to quite a few other central banks too. So today they're coming to talk to us about a very important topic, and I think it's also one of the hottest topics in the moment, hotly discussed in both academia and in the academic circle. So we're going to have Haoxiang and Rod presenting on interest-bearing central bank digital currency. I guess the case is in the US. And the floor is yours. Anybody, if you have any questions, please feel free to jump in and ask them.
Great. Thank you very much, Feng. Okay. Great. Thank you very much for having us, and really great pleasure to be here. And this joint work is Rod, and Rod is online. So if you have any hard question about monetary economics or monetary policy, I guess I'll defer this to Rod. This paper is about interest-bearing CBDC. In the US, when we say in the US, we really mean that the model that we construct here applies to the US. It does not mean that it doesn't apply to other countries. So we just try to be conservative here. And I think the type of framework could be useful actually in many other countries if there's adjustment to be needed. So for motivation, let me start with this quote from the Deputy Governor of the Bank of England, Ben Broadbent. If all the CBDC did was to substitute for cash, namely bearing no interest and coming without any of the actual services we get with the bank accounts, then people would probably still want to keep most of their money in commercial banks. So this is a pretty, this is a pretty important idea. And indeed, in the model, sort of this is one motivation why we have the interest for the CBDC, because it is going to, in a sense, sort of serve as a credible competition in the deposit market with very low interest paying deposit accounts. So what we do here are really two things. So the first part of the paper is really about a model, a framework about competition in the deposit market with the large bank and with the small banks. This heterogeneity, I'll discuss shortly, drives a lot of interesting results. I have to also say that this is, in a sense, a partial equilibrium model. We do not model many other things in the economy, such as labor market, such as goods market. However, we believe the model, in a sense, has this richness to think about the competition with heterogeneous banks, and the model itself could be a plug-in if one wants to put it on top of a bigger framework. Now, the second thing we do is to add a central bank digital currency that also pays interest. In addition, the CBDC also bears some of the convenience value of commercial deposit. So in that sense, the CBDC in our model will be a credible competition in the sense with the commercial deposits. It's going to change the competitiveness of the deposit market, and I'll show shortly. To give a sort of overview of the key features and sort of a bit more further motivation, the model is tailored to the US market. Now, exactly in what way? There is a huge amount of reserves in trillions in the banking system. Now that happened post crisis, I mean the last crisis, now the current COVID crisis. Now in that, since that crisis, the banks start to earn the interest on excess reserves that the Federal Reserve prescribes, right? So that's IOER post 2009. Before that, the bank's excess reserves could be lent out in the Fed fund market, in the sense interbank market, to earn a market-based deposit rate. So these two are, in a sense, slightly different, because the latter one is more of an administered rate rather than a market-driven rate. and if you look at the deposit market itself, the deposit rate is really irresponsive. Or I guess it responds to some extent to IOER, but quite often it is not responding one for one. So these are the sort of moments we really want to capture, especially the last one. And we also have heterogeneous banks. Heterogeneous banks are really important in our view, but it's not sufficiently addressed in the previous literature. We do think about not only the aggregate, but rather in addition to that, the sort of the winners and the losers, right? The haves and have-nots, the big and the small, in the sense that the small banks really support the most vulnerable communities in the country and in the world. So their kind of welfare, the small banks playing their competitive landscape really matters for the economy. When monetary policy changes, shifting the IOER, or when monetary policy that is yet, at least conceptually might change on the interest on CBDC, we would see that the big banks and the small banks, their market shares start to shift around. So in that sense, monetary policy does change the competitive landscape of the banking industry. Okay, so here's the chart of the US deposit rate and the US central bank rate over this roughly 35 years from 1986 to 2020. The blue line is the domestic deposit rate added across all the banks. Basically, I took all the deposit on the domestic deposits across all the banks, and the total domestic interest expense, and just do the symbol conversion. And I compare that to the maximum of Fed fund rate and IOER. Now, what we see is that there are really kind of two regimes, if you like. Now, the first regime is when the rate was kind of high, think about around this period, right? We see that when the Fed start to raise rate, the commercial bank's deposit rate moves around, yes, but not sufficient. You can see like it's a big increase, whereas a very small increase here. So there's always sort of a gap between the Fed interest rate that it pays to the banks and the deposit rate that the banks paying to the depositors. Now, the sort of second regime is when the Federal Reserve slashes interest rate very aggressively, usually in the prices. We see the bit of a lagged response on the blue line. And if you look at this period, basically both rates kind of get stuck in a very low level. So our model, even though it's simple, I'm yet to show you, but it does have the potential to match the US deposit rate shown here. Model prediction is the gray line. So it does respond to the central bank rate to some extent, but not perfectly. And in addition, in a period at very low rate, it's going to be basically stuck at the lower bound. Okay, so let me do a quick overview of what we find. First, let's think about the world without the CBDC. We find that the small banks deposit rate is higher than the big banks, and the small banks deposit rate is more responsive to the interest on excess reserve (IOR) than the large banks, right? So when the Fed raises the interest rate, the small bank basically follows more closely and actually at a higher deposit rate. In addition, if the central bank raises the interest on reserve, that's actually going to weakly increase the deposit rate on both banks, and moreover, increase the market share of the small bank. Another way of saying the same thing is that in a period of prolonged low interest rate, it is the big banks that benefit and the small banks that suffer. So there's some distribution effect in the economy. As the interest rate go lower and lower, we do see that the big banks start to, in the model, gaining more and more market share. Now let's add in the CBDC. Because now there are two rates, we really have a lot of degree of freedom. So the first thing we did is to hold the interest on reserve fixed, okay, and start to move around the interest on the CBDC. And when the CBDC interest rate start to go up, it actually reduces the deposit market share of the small bank. In addition, it could have ambiguous impact on the small bank's deposit rate. Numerically, we have not found this ambiguous effect, even though in theory that could happen. I'll show you maybe a bit of math later. We just cannot assign the derivative yet. In the lending market, we find that.
Haoxiang,
yeah, please,
can I just stop you a little bit here before you go on? Maybe you're going to talk about this later. But my question is, so you talked about the three interest rates, Fed funds rate, the LOR on the excessive reserve, and now you're talking about CBDC interest rate. And you talked also that, so you had the graph of two interest rates, right? And you're talking about the maximum of Fed funds rate and LER.
Yeah.
But these two are still quite different thing, right? In my understanding of policy rates.
Yeah.
And
yeah.
the IOER was something new, particularly related to crisis. And also in the sense that I guess if you look at the FOMC releases, you could still see now Fed funds rate is still, probably the first interest rate that they talk about when they talk about policy. Yeah. And LER, how do you figure the relationship between the two? Because going forward, I guess we are, in a way, when we normalize the balance sheet, right, we're still going to keep Fed funds rate as the main interest rate, main policy rate. And now you have the CBDC rate. How do you relate all these three interest rates?
It's really good question, Feng. Thank you for raising this at this point. So you are right. IOER applies after the 2009 crisis, I guess 2009 crisis. It is rate paid directly to the banks for keeping the reserves with the central bank. Now the Fed fund rate is more of a market-driven rate. Throughout this period, if you look at this period, most of the time, I say most of the quarters, vast majority of the quarters, the IOER is higher than the Fed fund. Now this has to do with the question of who has access to the central bank balance sheet, right? Whoever has access to the central bank balance sheet get paid IOER. Those who do not have the central bank balance sheet access could lend in the Fed fund market to those who do, right, have access. So the Fed fund rate in the data is going to be less than IOER. Now, if you think about the bank does have access to the central bank balance sheet. So the opportunity cost of the capital, or kind of what's the risk-free rate for the bank, it is going to be the IOER. Whereas Fed fund is more for everybody else. I mean, Rod, feel free to jump in here, but I suspect that there is a bit of a uncertainty sort of going in the long run, in the long term, whether the central bank would eventually wind down all of the reserves and the Fed fund market become important again, or alternatively, we sort of keep the reserves really high, permanently high, so the Fed fund market would eventually kind of get a diminished relevance over the years. And basically, in the current world, we are thinking primarily as IOER, and then there is a CBDC rate. So there are basically two numbers in the model, IOER and the CBDC rate.
Yeah, that's exactly correct. So since the crisis, since IOER came into existence, it's been generally higher than the federal funds rate. In the world of high excess reserves, essentially the supply curve of reserves shifted way to the right. The equilibrium price of reserves would have been zero, except the introduction of the administered rate was intended to put a floor. Now, IOER didn't become a perfect floor, and so often the Fed funds rate trades below IOER. And there's been some rare instances when the Fed funds rate recently has traded above IOER, but generally speaking, IOER is the relevant rate post-crisis, and the market determined equilibrium Fed funds rate is the relevant rate before the crisis.
Right, thank you, Rob. Absolutely. Okay, so coming back to the lending market, we find that large banks' investment criterion is less stringent, meaning than the small banks, meaning the loan quality, average loan quality of large banks is actually worse than the smaller banks. This is related to the fact that the large bank could have funding with a low deposit rate. An increase in the interest on reserve leads to less lending by the large banks. However, it might increase lending by the small bank. So as we raise interest rate, it is possible that lending would reallocate from large banks of the cities and JP Morgans into smaller community banks. The overall effect, however, is a slight reduction in total lending. So there is some substitution effect between big and small banks. Now, if we introduce the CBDC, an increase in the CBDC rate, at least theoretically, could have ambiguous impact on the small and large banks required lending criterion. However, if the small banks deposit rate increases in the CBDC rate, which I guess is numerically seems to be the case in some examples we tried, then the loan quality threshold increases and loan volume decreases at the small bank with the CBDC rate. So I have to sort of caveat up front that, you know, we just started sort of experimenting and exploiting the impact of CBDC because of the basically distributional function that you'll show in a moment, you'll see in a moment. We have not tried all the configurations, so there could be potentially more more surprising results coming out of this. Yeah, maybe very quickly on the literature, as Rod just said, we just discussed, it is related to the literature of sort of the idea that how do you conduct monetary policy with a huge amount of reserves? It used to be through the Fed fund market, where the central bank either injects liquidity or kind of mop up liquidity through open market operations, buying and selling treasury securities. However, if you have trillions of dollars reserve, that method become ineffective. So the central bank merely just sets an administered rate, IOR, rather than sort of going through this open market operation through the Fed fund market. So the IOR becomes the more relevant policy tool after 2009. And Martin McAndrews-Ski and Ofado sort of papers along this line. Without going into details, we do share the feature with them that the aggregate bank lending is sort of depends on the quality of the project itself, depends on the opportunity cost of funds, but does not necessarily depends on the aggregate amount of the bank reserves. So when the central bank thinking about shrinking the reserve kind of bring back to normal, it does not necessarily reduce lending in this world. There are also many papers about CBDC, and certainly we are not doing justice to the huge literature that's kind of springing up. We only kind of listen in a few here. They all have different features, and some of them use established kind of big model framework. Some of them are sort of construct themselves, depending on the bank's competitiveness, depending on other features, one could have slightly different results. The idea that we have is to say that given that we want to look at the monetary policy and the CBDC, at least in the confines of a US context, we want to set up the features so that it at least works sort of for the US and the realistic. So in that sense, our model is really closest to Ofado's paper, except that we don't have this overlapping generation framework. It's actually a much simpler model in our case. There are two primary differences between these two. Even though sort of in both papers, reserves are abundant, lending determined by the performance threshold, the quality threshold, and the banks have monopoly power in lending market. In our model, this opportunity cost of capital is actually lower than the interest on excess reserves, because there's a possibility that the deposit or the money lent out can actually eventually come back to the bank's balance sheet. And moreover, the important thing is that the big bank would see a higher probability that the money lent out would come back because of higher market share in the deposit market. So there is an interesting interaction between the market share of the deposit side and the lending side. Another key difference is that we have heterogeneous banks for the reasons that we just emphasized, that the differential impact of CBDC and IOR on banks of different sizes seems to be a quite important feature that one could potentially explore empirically and for policy. Okay, now with that introduction, let me talk about the model and then talk about interest-bearing CBDC. So for this part, there will be no CBDC, but it's going to be a model about the deposit competition and the lending, mostly deposit competition. And then once we set up this framework, we are going to introduce an interest-bearing CBDC and see how that changes the market outcome. So here's the model. There's one large bank and one small bank. The bank assets are really central bank reserves. For simplicity, we call them XL and XS. Those two numbers are determined exogenously for now. And in the model solution, they do not really show up in the solution as much. But think about this as the sort of start of the state. And eventually, we might think about them as sort of as a dynamic version where XL and XS start to evolve over time. But for now, it's sort of a one-shot game, right? We start with this level of reserves, and these reserves are kind of backed by liabilities deposit, right, to the retail investors, whoever, to businesses. So the central bank balance sheet would be asset side bank reserve, central bank reserve, liability side deposit. An important feature is that the central bank pays interest on reserve on those assets, XL and XS. The agents in the model, I really sort of think about them as three phases. They play three roles. There's unit mass of agents, could be firms, could be individuals, doesn't matter. They first play the role of being an entrepreneur. Think about the individual. Agent I is endowed with a project of quality. We call that quality, meaning success probability QI, from a distribution. The cumulative distribution would be big Q. Project I requires $1 investment, which is normalization, and it pays A greater than 1 if it succeeds. Otherwise, it pays 0. Okay, so agent I can only borrow from the bank where she keeps the deposit. Okay, so that's the assumption that you do have a relationship bank. So in the in the lending market, there's not much competition going on. As a result, the bank is going to keep all the surplus in the lending market. Now, once the entrepreneur gets this project and gets the funding, she's going to draw a worker randomly selected from the population. And basically, the worker is going to work on the project like contractor and get paid the full dollar. And we can also interpret the worker as a supplier. It doesn't really matter the label. What really matters is that the money that is borrowed from the bank is going to kind of go to the broad economy in some fashion, right? There will be some shuffling of who keeps the deposit. That's all we need. And finally, once the worker receives the wage, the $1, she is going to deposit it in the bank. Now here's where the most of the action is taking place. The choice of the bank is endogenous. Besides deposit rate, the worker's convenience value of depositing at the large bank is denoted by this number delta, and it is a random variable with a cumulative distribution function G. So think about the population kind of differs in the dimension of convenience value, right? So some people might just like to be able to step into the branch wherever they go, whereas others don't care. So the former person would attach a very high convenience value of delta. And because of this delta, and because the depositor observed the two rates, big bank and small bank, she's going to choose which one it is. So just to kind of organize this model in the timeline, in the beginning, the banks would set the deposit rate, RL, which is large bank, and RS is the small bank's deposit rate. There's also zero lower bound. Later, when CBDC comes in, CBDC rate would be lower bound. But for now, let's call the zero lower bound. If the deposit rate goes negative, then the agents would keep cash, right? So RL and RS would be at least 0 or positive. At the time one,
Haoxiang?
Yeah, please.
Does the
yeah.
There are two kinds of banks. Is it just like each one kind only have one bank, or each kind have a bunch of continuum banks?
Good question. Each kind has exactly one bank.
Okay.
So there are two banks. There's JP Morgan Chase, and there's our community bank.
It matters for the competition. I haven't seen how you do it, but I think.
Yeah, I'll show you in the next slides.
Okay.
There will be competition in the deposit market. So each agent is endowed with the project and goes to the relationship bank. Now this part is actually not as critical right now. Think about the agents that distributed across between the two banks in some fashion. Whichever bank that you happen to bank with this year, because the bank has all your data, yeah, you're going to go to that bank to borrow. And the bank prices the loan as a monopolist. The delinquency cost would be lambda. For now, you can think about the lambda as 0 or whatever. It doesn't really play a very important role right here. If the loan is granted in period 2, a founded entrepreneur is going to pay the dollar, which is the lending amount, as a wage to a randomly selected worker. Now, the selected worker is going to choose the bank depending on the rate and her convenience value of delta. And the bank's market share for the new deposit would be alpha L and alpha S. We are going to look for the equilibrium in which alpha S is less than alpha L, because the other way, if it's the other way around, then we can relabel them the other way around. So in the final period, the project's payoff are realized. So here is the typical balance sheet of the bank. We are going to think about this as the big bank. Of course, the small bank would be entirely analogous. So in the start of the period, the bank has reserve as asset and has deposit as liabilities. Once the large banks make a loan of $1, so how does it work? Is that it creates the new deposit in the name of the entrepreneur, 1. And it creates a loan on the asset side, also 1, all right? Rather than the reduction of reserve, okay? So it's not that you lend out the money you kept in the vault. No, it's that you create a deposit in the name of the borrower and also create a loan. So there is expansion of balance sheet at that moment. Now, once the entrepreneur spends the money to pay a worker, to pay a supplier, it doesn't matter, we'll see the balance sheet will start to change. Now, from the big bank's perspective, all the bank cares is with what likelihood, what probability would the new deposit leave the bank, all right? Now, if the big bank, large bank, has the market share of alpha L, then with the probability alpha L, the new deposit stays, right? Because if I borrow from JP Morgan and I pay my supplier, then with a very high probability that JP Morgan still has the supplier's bank account. So the deposit actually stays within the bank. With the probability alpha S, the dollar would leave. When the dollar leaves the bank, it's going to come out as a form of reserve. So the reserve would flow from the big bank to the small bank, right? So this is the sort of ending balance sheet, if you like. So here, this is where the bank market share also matters a lot, because the probability that the money flows back depends critically on the market share in the deposit market. Okay, now what is the lending criterion for the bank? So here, I'm just enumerating all the items on the balance sheet. So the first line enumerates all the items on the last balance sheet, right? So what did the bank earns on the reserve, which is the central bank rate? What did the bank earns on the loan, minus what did the bank pays on the deposit, right? So that's the 3 terms. Interest on reserve, XL minus FS times F. F is central bank rate. The gross profit on the loan, which is the Q, probability of success, times the return condition of success, minus delinquency cost, minus the principal. And that's the cost reserves in the end, right? If the bank does not make the loan, then what I'm doing is to count the items on the first table, which is simply the spread between the deposit rate at the central bank and the retail deposit market. So by taking the difference of the 2 equations, we see that the large bank's marginal profit for making the loan is the net profit on the loan, which is sort of NPV, if you like. It's actually future value, because the true opportunity cost of the funds is F, plus a spread. The spread is the central bank rate, F, minus the commercial deposit rate, RL, multiplied by the probability that the money comes back to the large bank. So here is where I think the sort of things get interesting. Every dollar lent out not only earns the big bank the NPV of the project, but also a profit on the interest rate spread, right? So think about in a world where there's only one bank. This is why heterogeneous bank matters. If there's only one bank, alpha L would be 1, right? So there's no opportunity cost of lending because the bank always keeps all the deposit. So when we have heterogeneous banks, we will see that last term really would vary between large and small banks, right? In the sense, this is the true sort of advantage of a large bank in the deposit market, how that spills over to the small to the lending market. So that's the lending criterion. Now let's sort of go forward at the time period 2. What about deposit market and what's the competition? Here, the model is really kept simple. You're the depositor, you have $1, and you look at the 2 rates. One is RL, the other is RS. You also attach a convenience value delta to choose the large bank because of convenience. So you are going to choose large bank if your convenience value is greater than the interest rate spread, right? So we could see JP Morgan pays 0, whereas if your community bank, say, pays 1%. If your convenience value is greater than 1%, then you're going to choose the large one. So the market share of the large and small banks is going to be 1 minus G of this spread. Remember, G is the distribution function of delta, right? So of delta. And the small bank's market share is going to be the probability that the delta is actually less than RS minus RL. Any question here? So that's kind of how they compete.
Can I reiterate my question? So
yes, please.
Your previous slides, I see the
here.
so here is basically saying that there are some of the deposits coming back, and I'm
Yeah.
gaining from it. IL, right? F minus IL.
Absolutely. Yeah.
So I'm thinking, suppose you have a two sector, like a big bank sector and the small bank sector. Then I will think that the competition among homogeneous banks potentially will compete, like basically giving away these rents to the depositor, depending on how you model those things.
Yeah, that's a really good point. So if I mean, I guess your question is really, why wouldn't JP Morgan Chase and the Citibank, right?
Yes.
The deposit rate up to
my question. Yes.
Right. So I guess, you know, they are different.
And let me just, I think it's okay to let these small banks have those local monopolist power for these depositors. For big banks, I would imagine it's extremely fierce.
Oh, I see what you're saying. I see what you're saying. Yeah. So if I drive 500 miles west, right, go to a little town, and probably I would not find the JP Morgan. I would find the local community bank. That's fair. I think in that regard, by the way, the model is general enough, right? I mean, what I have in mind is that the model really applies market to market, and namely location to location, right? So what the bank has a convenience value in, you know, here in Boston, or sort of in Chicago, or in Beijing, in Hangzhou are different, whereas in let's say San Francisco or whatever. So the effect of a small bank dominating in the local community, it could be accommodated in the model by just putting the convenience value to the small bank. On your first question about the multiple large banks, I think in the data, even though JP Morgan Chase and the Citibank and Bank of America, they could compete, they don't. I think there is a certain market power even in that segment, because of the cost of you know, switching banks, for example. I think as long as there's some kind of a friction, there will be a kind of a monopoly power, or at least market power. So one of the friction that we sort of really using to the extreme, I guess, is that the information advantage that a big bank has on all of your activities, right? So, I mean, that could, you know, prevent the big banks from competing away all the surplus. Yeah, but that's both great questions. Okay, so that's the market shares, and now we can think about the loan market. What is the the lending criterion? So we have just seen that the big banks would lend if the NPV of the loan plus the interest rate spread is positive, and that's going to determine the minimum quality that of the project that the large bank is willing to lend. You can see that if this number goes up, then the quality threshold is generally lower. The same calculation shows that the small bank would have such a threshold, whereas this number is important. Remember, all of the alpha L, this is 1 minus G, RS minus RL, whereas alpha S is G of RS minus RL. So all of this interest rate actually plays into the lending market through this this channel. Okay. So how do we think about the choice of deposit? We already seen that the choice of deposit is sort of going to the bank that has the sort of convenience value adjusted higher interest rate. So the total profit of the bank is going to be the integral, right, of all the projects, NPV plus the interest rate spread. And of course, there's lower bound of QL. And the technical conditions that guarantees that we can use the first order condition. We can actually write the first order condition as follows, and likewise with the small bank. If you take the difference between the two equations, you can see that by looking for the equilibrium where the big bank has a bigger share, then obviously the small bank will quote a higher interest rate, deposit interest rate than the large bank. Okay, when the lower bound is not binding, right? So that is when both of these first order conditions are equalities. We can also show that when the interest rate zero lower bound is not binding, then the quality threshold of the large banks is actually worse than the smaller banks. So basically, when the rate is high, think about again when the central bank rate is high, the small bank would set a high interest rate, not only higher interest rate but also more stringent lending standards. This is again because when the interest rate is sort of higher, the small bank understands that there's lower probability that the money comes back, right? So the interest rate spread term is going to be smaller. That is why the small bank would set a higher quality threshold in the lending market. So that's basically proposition one. Without CBDC, if the solutions RL and RS are sort of interior, then we do have this ranking, right? Central bank rate is highest, then the small bank's deposit rate, then it's large bank's deposit rate. And also the quality threshold is worse at the large bank.
For a long while, I thought you interpret F as IOR, right? IOER. Or
yeah.
For a long while, that those things are just zero. So how do you...
Absolutely, I'm going to go there. Bear with me with one second, yeah. Right. So Zhuguo is asking, what if this is zero with the zero lower bound? So without when it's not binding, one could actually solve this first order conditions with the uniform distribution, and we see that basically the small bank would quote the IOER minus a third of delta, where this is a parameter, and the big bank would quote F minus 2/3 delta. So there's a spread of a third of delta, whereas delta is the maximum convenience value of the population, right? So think about if this is say 3%, then on average, the big bank is going to quote a lower interest rate by 1% than the small bank. And then clearly the lower bound does not bind. It means RL is greater than 0, and that only works, right, when the rate is already high, right? When the central bank rate is at least 2/3 of delta. In this example, if delta is 3%, then that applies if F is above 2%. Now let's come to Zhuguo's question. What if there's a zero lower bound? That happens when F is low, right? When F is low, the large bank, in fact, does not want to quote any positive rate because of convenience value, the large bank could just keep a zero rate and still get some market share of the deposit. So we are going to use the notation that RL plus to denote the maximum of the unconstrained RL, right? Large bank interest rate and 0. And we do the same thing with RS, even though in fact, this then is never 0, right? This will be positive. When the zero lower bound is binding, the small bank's first order condition is still inequality. It's the interior solution given by this equation. But the large bank's first order condition is actually different. It's actually this one, right? Remember, in fact, there is F minus RL plus in it. And we're going to plug in RL is equal to 0, right? So that's going to be the first order condition, meaning at this point, at the zero lower bound, the large bank really wants to make a negative deposit rate. But because of lower bound, it cannot go, right? So the large bank kind of get stuck at exactly 0. We can also show that both banks do not want to kind of quote 0. The reason is if both banks were to quote 0, then the small bank would have an incentive to slightly increase the rate in order to gain a lot of market share. Because if both banks quote 0, then the small bank doesn't have any convenience value, therefore lose all the deposits. So the corner solution is that the large bank quotes 0, whereas the small bank quotes a positive number. So the small bank's rate is RS plus, large bank is 0. The same result that the loan quality threshold is higher with the small bank. In the uniform distribution, we can solve that the small bank at the lower bound, when the large bank get stuck at the zero lower bound, the small bank will quote a rate that is a half of the central bank rate, given the uniform distribution. Okay, and this applies when F is low enough. Right, that's exactly where the intuition goes. When the central bank rate start to go down, large bank first get hit 0, and the small bank kind of goes slowly toward 0 with the central bank at a rate of half. Okay, so how does the interest rate on reserve change the market outcomes? Since we have already solved both cases, here we are going to focus on the second case with the zero bound lower bound binding. That seems to be the sort of more relevant case, at least in recent periods. Increase in the interest rate on reserve leads to a higher interest rate of the smaller bank. I mean, this sort of this conclusion does not depend on the uniform distribution, but rather general. Increasing IOR increases the interest rate of the small bank. The large bank's rate is again stuck at 0, right? But also by increasing the interest on reserve, the small bank gains market share. This is because by raising the central bank rate, the small bank could potentially raise rate without losing money, right? So that gives the small bank additional lever to compete. Another way to compete with the large bank is to offer a more explicit rate rather than this convenience value. The higher rate, central bank rate, would also lead to higher quality thresholds by the two banks, QL and QS. In terms of the loan outcome, something interesting happens. A higher interest rate on reserve would lead to a lower volume of loans by the large bank and both banks combined, but it has ambiguous impact on the small bank's loan volume. I'll show you this more clearly in the picture momentarily. This has to do with the shape of the market share in the deposit market, because now the small bank has a higher fraction of the deposit. So the money would come back, right, to the small bank with a higher probability. Therefore, the small banks sort of more willing to make loans. Yeah.
Haoxiang, just to confirm that my intuition. So in the previous slide, this is I'm intrigued by the second result. The market share. Is this also the case when it's not binding? That's a deposit share, right?
Oh, yeah, that's right.
So when it's always the case.
Yeah, when it's not binding, they wouldn't move.
It wouldn't move. I see. Yeah, that's
okay. Yeah, when it's not. Yeah, when it's. Yeah, let me think. Yeah, I mean that's my intuition, because let me think if we didn't really solve this one. Maybe we should.
But in here, it's a large guy is binds. So they would like to compete more, but they couldn't.
Right. So when the large bank, right? So in this case, let's say RS is positive and RL 0, right?
Yeah.
When F goes up, so RS would go up and RL stays at 0. What it really means is that the small bank could compete by increasing the deposit rate, and because the depositors still like the convenience value of the big bank, right?
Yeah.
So big banks still have a lot of depositors.
Yeah, but what I'm saying is, suppose some implicits look at this without seeing the driver is F. Okay. What they see is that's consistent. It's just the interest rate go up, so they move there. The smaller guys move there, I guess.
Yeah, the smaller guys would increase the rate to compete, but the large bank, I mean, remember the first other condition for the large bank is sort of inequality, right?
Yeah, I understand.
Yeah.
So would be useful to check that if it's not binding, is this still general result or not?
Yeah, okay. When it's not binding, in the numerical calculation, I'll show you. I mean, that's going to be a constant, but you're right. I guess we should check the more general results. Yeah. Okay. So how does the IOR affect the deposit rate and the market shares? I mean, here are some calculation, but I will kind of skip the details and directly come to the graph. Okay, so here's a graph that we are using the uniform distribution of GX equal to X over 9%. So what it means is that the consumer that has the highest convenience value is actually 9%. It's pretty large, okay? And the break-even point in the interest on reserve is actually 6%. So when the central bank rate is below 6%, we can see the large bank would basically quote a rate of 0. And only after that is going to go up. Remember, this is F minus 2/3 delta. And for the small bank, this is half F when the large bank is bound by 0 lower bound. And this point is F minus 1/3 delta. So there is a wedge between these two rates, and they sort of never meet, I guess. On the right-hand side, there's the market shares, and we can see that as the rates start to go up, the large banks' market share start to go down, right? They start at 1, right? So this is sort of a point, maybe kind of worth emphasizing, that because of the convenience value of going to a large bank, you can find a branch everywhere. It's very easy to do the money transfer, etc. Large bank has inherent advantage when the rate is low. Only when the rate start to raise, we do see that small banks start to gain market share, and eventually the spread is become a constant, right? remember the market share really depends on the difference between the two rates. So when the two rates become the difference between the two rates become a constant, the market share kind of stops moving around. So that's why they move in parallel right here.
So
Now here's, yeah, please.
Yeah. So in the whole paper, you're talking about IOR, right? Not on IOER.
Oh yeah. Thank you. This is a good clarification. So it used to be interest on excess reserve. I guess after COVID, the reserve requirement got scrapped. Rod, correct me if I'm wrong. So in IOER, in today's world, is sort of is the same as IOR because excess become meaningless in a sense. And by the way, required reserve is very tiny compared to the excess reserves, right? So primarily it is about, yeah.
Yeah, I understand that point.
Yeah.
But looking at the model, I don't know if I'm fully understanding, because the circumstances when IOER came out was in a way, although it came out after the crisis, but later it began actually important tool in the toolbox for the Federal Reserve to think about the exit from quantitative easing. And eventually, when they really began to use it, it was used, I guess, to actually withdraw liquidity from the market.
I'm not
when the economy was going better, right? I remember there were a lot of discussions on LER when I was in the meetings among the central banks. But one of the key things that I remember the Federal Reserve, they worked a lot and they actually wrote a note, was LER's role. Once they couldn't reduce the balance sheet so quickly, then LER would serve was a very important role in regulate liquidity. And also central bank, the CBDC rate, in a sense, when people talk about the motivation for CBDC, and when people talk about it being useful, was precisely, in the period that you can drive it to negative in the circumstances when you're in the zero lower bound, right? Because then you get a negative interest rate.
Oh,
and
right.
Then that's actually the goal is actually put deposit rate into the negative domain so that people can spend on consumption. So I see when you're talking about in the case of zero lower bound, you're talking about the case that banks were competing and the deposit rate was positive. I don't know if I get it right, but that's against the objective of the central bank of having a negative rate, particularly on CBDC, right?
So let me, yeah, this is a good point. I mean, people did talk about have a negative rate on CBDC. I think in the U.S. context, Rod, you should jump in. It's really hard to set a negative rate. If you compare across countries, I know that in Europe people kind of don't use cash as much, but in the U.S. people still use cash and the checks, a lot. And it's very hard to think about economically or politically to be feasible to charge an interest rate on CBDC. I mean, people have to pay to get access to CBDC. I'm not sure it would work really well in the US. Maybe in some European countries where you don't reuse cash, like Sweden, where the actual central bank rate is pretty negative. Yeah. Anyway, so I don't know if okay.
Yeah, no, that's right. At least in the context of the model, we have cash in the model as an alternative. So the existence of cash creates this zero lower bound, and I think that's a reasonable representation of the U.S. economy, at least currently. So I think it's reasonable to still consider the idea that there's a binding zero lower bound.
Yeah, so in a sense, I guess we are going back to the initially when you're talking about whether the current situation at the Federal Reserve is kind of normal situation or kind of say new normal, or is really something that is abnormal, that the Federal Reserve is eventually going back to a much leaner balance sheet. So if it is going to keep a large balance sheet and operating under large balance sheet, I guess that would be very different from the whole period since 2018 December, right? When the zero lower bound began binding and big balance sheet became the normal. If we return to a leaner balance sheet, I don't know how, how your model would work. And if it stays with a zero lower bound or close to the zero lower bound with a large balance sheet, in which circumstances would your model be be adequate?
So Haoxiang, maybe I'll just say one quick thing. So
Go ahead.
the Fed did announce just over a year ago that they were going to persist with a high level of reserves, and then of course results resulting from liquidity injections having to do with COVID-19 has made that just sort of necessary to exist with a large level of reserves. But the model works regardless. So what Haoxiang will probably show you in a minute is that what we really care about is what's driving the opportunity cost of funds when banks lend. And that can either be IOER or it can be the federal funds rate, whichever is higher. So the model will applies both to the pre-crisis and the post-crisis regime.
Yeah, absolutely. In fact, right, if you look at this rate hike right here, before COVID, this is the period, after 2016, this is the period when the central bank still have a huge amount of reserves, right, in the balance sheet. And yet it actually started to raise interest rates. So I guess the model is still relevant in this case, because when the CBDC comes in, it could potentially offer a rate that is lower, say right here. So again, this is the chart I showed you earlier. The gray line basically.
Just go
ahead, Phil.
You can go ahead, but just one word. I think actually the period from 2009 and 2015 is a very special period, and probably the one that we were talking about all this unconventional monetary policy. But if you look at since the end of 2015, indeed, as you're saying, that's different. But that's the time when IOER became positive. They raised it by 50 basis points, and precisely it was the economy was getting better, and they began to think about regulating the liquidity in the economy. So actually, if I look at this picture, I would think between 2009 and 2015 is a different period from the rest. And of course, COVID came in, and it went back to that special period again.
Yes.
But you can go on. I think we can discuss about this later.
I agree. Generally, I agree. This is when the lower bound starts to kind of binding, whereas the rest is kind of more not binding. But the model has a chance of fitting, even though it's not perfect fit. We didn't really fit any of this square, but you can see that generally the shape is there. And this is the Canadian picture. You can see this is a kind of a 20-year period, and the model kind of fits, in a sense, almost even better. And another thing kind of interesting to us is that in both pictures, the 3.5% seems to fit the picture quite well. Namely, the highest value of convenience by any depositor is 3.5%. Okay, now here's the lending. Now, what is the lending market in this model? So the lending volume is actually here, alpha would be the fraction of the depositors that are with any bank, say large bank. And among these depositors, the bank is going to choose a quality threshold Q so that the amount lent is only 1 minus big Q of small q. Now we call this alpha J0 the initial fraction. And in this model, we're going to proceed in this sort of a stationarity idea. That initial fraction is sort of the same thing as the n fraction. Another way of saying this is that if we assume that the large bank's reserve over the small bank's reserve in the very beginning is equal to the ratio of the market shares of the newly created deposit, then the whole thing would almost like go forward like a sort of a stationary equilibrium. So here's the total lending actually goes down in the IOR rate F, and the T, the total lending, big minus plus small, is also the total deposit created. So in this model, whenever the bank makes a loan, they create a deposit, and that amount of deposit kind of flows around in the economy by paying the workers, etc. Eventually end up on the same bank or the different bank's balance sheet, right? So the total deposits start to expand in this model, and the amount of expansion is the same as the total deposit created. So here's a chart about lending. So I'm writing again the quality threshold of QL and QS on the top. We can see that as interest on reserve start to go up, the loan quality threshold start to go up for both banks. This is because, remember, when the banks makes a loan, the money might come back right, with some probability. And whenever the money comes back, it creates additional value of spread, right, for the large bank, and this is for the smaller bank. So when F is higher, right, the value of sort of using the central bank balance sheet is sort of higher, right, because we're really talking about versus you just without lending. So the quality threshold start to go up, and the loan volume in this case start to go down. So you see the black line. Now, interestingly, we see that the small banks loan volume actually start to go up when the interest on reserve start to go up. Let me sort of discuss why this happens. First of all, we know that the loan quality threshold right here start to go up, right? So that effect by itself is going to sort of reduce lending, right? On the other hand, there is a composition effect, because when the central bank rate start to go up, the small bank in the deposit market have another lever to compete. So the small bank would raise its deposit rate. That's going to attract more deposit into the small bank. By attracting more deposit into the small bank in the sense start to get a slightly lower cost of funds in lending, right? Because there's an actual term. Think about when this term goes up, it finds more attractive to lend. So that effect actually increases the amount of lending by the small bank. The big bank, however, start to lose the market share, right? So alpha L, F minus RL, this alpha L start to go down. So that's going to further decrease the big bank's lending incentive. In addition, so why does the sort of total lending goes down? This is because deposit is now reallocated from a large bank that has a lower threshold of lending to the small bank that has a higher threshold of lending, right? So you basically go from a kind of loose lender to a strict lender. Even though there is some reallocation, the reallocation is not 100%. That is why you see the total loan volume goes down a little. Now the interesting part, at least in this chart, I know it is very simplified numerical example, is that most of the volatility kind of of the loan volume comes from the reallocation, right? The slope is much steeper here than the total volume. So even though the total volume goes down, it's not sort of going down as steeply as large banks. So small banks generally gain from higher rate in the lending market. Okay, now finally, let me talk about CBDC. I'm going to sort of briefly kind of motivate why do we think about interest-bearing CBDC. In China, my understanding is that the RMB CBDC pays no interest. It is designed to replace cash and only cash. It is certainly not designed to replace any commercial deposit by offering no interest. Experimentation seems to have begun in Shenzhen and some other cities using the mobile app. I'm sure Ali, I mean, it's also a competitor. They're competing with the commercial kind of third-party payment providers like Alipay and WeChat Pay. At the other extreme, we have the Banking for All Act of the US being considered in Congress. You can see that it's pretty prescriptive. It says that the digital wallet shall not be subject to any counterfeit minimum balances or maximum balance, and shall pay interest at a rate not below or greater than the rate in the credit reserve and the rate of interest on excess reserves. In other words, in the US bill being considered, the central bank wants the CBDC rate, sorry, not the central bank, the bill wants CBDC rate to be the same as the as F, right, as LER. So we really have the spectrum of the two, 0 versus full amount of payment, just like commercial banks. So that sort of motivates us to think about a CBDC with explicit interest rate, but that rate is in the range between 0 and F. In addition,
it's can you? It's the first time I'm seeing this. The previous slide.
Yeah, this one. Yeah.
Yeah. That's interesting. So, does it apply to other institutions? Let's say mutual fund. Like imagine that later on CBDC, expanded to other, not just banks, not just depository institute. Is this the same or?
No, I think this is run sort of by my reading. For example, it could be run through the postal service. So it's not really kind of bound by the bank. It's more of a universal account, if you like. By the way, this is being considered. It's not passed yet.
Okay.
But and by the look of it, I would doubt if it will pass, but we'll see.
I see. Okay.
Yeah, it's kind of interesting, right? Kind of pretty prescriptive policies. So the first feature again is that S is between 0 and F. The second feature is that we are going to assume that's a modeling choice that the CBDC offered by the central bank is sort of through the infrastructure of commercial banks. So think about this as depositors. So they would have the commercial bank, and you have the central bank digital currency. So this is offered through a conduit, right? So the commercial bank would kind of pass through the CBDC. CBDC would remain on the balance sheet of a central bank, but the commercial bank would provide the services such as checks, money transfer, etc. For that reason, we are going to assume that the CBDC would inherit, right, the same convenience value of the commercial bank, large and small. So in that sense, if you remember the initial quote, the CBDC not only pays interest, but also gets all the convenience value of the commercial deposit. For that reason, the central bank digital currency in our model becomes a very credible threat of competition with the commercial banks. So it will serve as the lower bound of deposit rate. So that's why we have the two pluses to indicate that the lower bound is not just 0, but also S, which is the CBDC rate. Now I have talked about all the other propositions earlier, but you can see that this proposition and the next one would be very similar in the sense that if the lower bound is not binding, right, the CBDC rate S is not binding, then we have exactly the same first order conditions. And it's in a sense exactly the same result. Large bank has lower rate, large market share, large bank has a larger market share in the deposit market, and also a less stringent lending standards compared to the small bank. But if the CBDC rate is binding, then what happens is that the large bank, RL++ is equal to the CBDC rate, whereas RS is above. And in addition, the first order condition of the small bank is going to be, just as before, an equality, whereas for the large bank, it is an inequality. In this equilibrium, large bank again has larger market share and a less stringent lending standard compared to the small bank. So in our model, it's kind of a feature that once we put in the interest and put in the convenience value, the CBDC become almost a perfect substitute for commercial deposit. We could alternatively get rid of the convenience value of the CBDC or kind of model it slightly differently, and we would have some slightly different results. But for now, sort of it is a perfect substitute. So here's what happens if you move the interest on reserve in the world with the CBDC and without. The world without the CBDC is shown in the solid lines that you can see as shown before, whereas the dotted line is a CBDC that pays 2% if F is greater than 2% and 0 otherwise. Okay, so the CBDC pays 2% if the interest on reserve is above 2%, and otherwise CBDC doesn't pay anything. So imagine what happens around the 2%. We can see that immediately the central bank digital currency got introduced or kind of being kind of effective turn on, there will be a jump of interest rate by the large bank and the small bank. And the jump is bigger, right, for the large bank. As the interest on reserve start to move further to the right, and eventually they converge because we are moving to a region where the CBDC rate of 2% is too low to bind. Okay. On the right-hand side, we see that the market share, for example, if we look at this point, because the CBDC is introduced, we immediately see that the 2% lower bound start to bind, and the large bank start to gain market share. You can see this kind of arrow up, and the small bank start to lose market share. The reason is that at that point, right, the large bank wanted to offer 0, but the central bank digital currency bound the deposit rate above 2%. So the large bank is forced to raise the deposit rate. Because the large bank now has a higher deposit rate and it has a convenience value, it starts to have a real competitive advantage relative to the small banks. So the large bank market share start to increase. And of course, eventually they would converge to the case without the CBDC. Now, what happens in lending? Again, this is S equal to 2%, if and only if F is above 2%. Again, let's consider here, the loan quality jumps up, and you can see that the loan quality increase is fairly small for the small bank. This is because the small bank was offering pretty competitive, pretty good rate already, right? Half F. And for the big bank, it is a big increase of the deposit rate, therefore a big increase in the loan quality threshold. And if you compare the two lending lines, the two black lines, they're almost on top of each other, meaning the introduction of a CBDC with a modest interest rate, yes, it reduces lending, but a very small amount. Again, this is because a lot of the last loan volume of the big bank is sort of is compensated by the small bank, right? Sorry, go the other round. The last volume of the small bank is sort of compensated by the big bank. This is because once the CBDC, once the IOR, the interest on reserve is higher, the loan spread, the deposit rate spread between the two banks start to shrink. That's kind of shrinks the small bank's market share in both deposit and the lending. So in that sense, the introduction of a CBDC, if you fix the IOR and sort of vary the CBDC rate, it might sort of reduce the market share of the small bank.
Haoxiang, do you have time for a question?
Oh yeah, of course, yeah, Daryl.
So in your model, CBDC seems to be serving essentially the same role as a narrow bank. It doesn't really matter that much that it's issued by the central bank. What it needs to do is to compete for deposits. And as long as you pointed out just now, as long as it has a convenience yield that's big enough, maybe it doesn't need to offer anything close to IOER in order to have the same effect on driving up deposit rates at other banks.
Yeah, this is, yeah, thank you for, I mean, this framing is exactly right. I think the key here is that we do endow the CBDC the same convenience value. One could imagine different world, right? If you imagine a CBDC that has zero convenience value, then it has to offer a pretty aggressive rate in order to attract use. You know, if the app, for example, is terrible, then, you know, they would have to offer really high rate. But yeah, if it is offered through the commercial banking system, then the sort of a cost, if you like, right, or the rate on the CBDC does not have to be that aggressive for it to be very kind of a tenable competition.
Yeah, and likewise, you mentioned WeChat Pay and Alipay. They pay essentially zero interest, but they're eating the Chinese banks for lunch, essentially, in terms of at least the payment market, if not also causing the banks to have to pay up more interest.
Absolutely, the money market products certainly is a big sort of force for competition. I think the banks also strike back, right? You know, right now I think the money that you left in the digital wallet has to be backed by central bank money. I got the phone. I mean, the Luohan Academy folks, you should jump in if I'm inaccurate here. So I think the narrow bank is already being operated in the sense by the digital wallet of Alipay and WeChat Pay. Is that a correct statement?
It's correct by me.
Yeah, okay.
It is right.
But we have the right people. We have the right people on the phone.
That's right. Yeah. I was like, okay, am I saying something crazy? Okay. So Zhuguo says yes. Okay. So I guess.
Can I ask you? So here, so Daryl was asking narrow banking. I wasn't sure about your assumption. So CBDC, I know that right now that at least in the really pilot stage, early stage, they cannot make loan.
No,
it's the same assumption here. That's why Daryl was asking. Okay. It's like
it cannot. Yes. So the central bank does not lend. I think that's one of the sticky point, right? In the whole discussion of the CBDC is that who controls the credit provision? Our model says the commercial bank controls the credit provision. Still, all the central bank digital currency did is to sort of provide a little bit of a lower bound on the interest rate. Another way of saying this, right, in the broader scheme is that whenever the central bank start to move the central bank rate, monetary policy doesn't get passed through to the deposit market because of market power, right? So another way to kind of combat this market power is to use two rates. Instead of one rate, you kind of, the other rate is kind of nudging, the CBDC rate kind of nudges slightly the commercial bank not to exert too much market power. So there might be more effective monetary policy pass through. Yeah, I mean, I personally don't envision that CBDC. Yeah, go ahead, Daryl.
I just wanted to mention there's a really interesting white paper by an ECB official named Ulrich Bindseil, Bindseil, that makes the point that you just made on compensation with the CBDC.
Okay, yeah, thank you. I'll dig it out. Yeah. Yeah. By the way, if you know of any reference or any of the audience have any reference on this, we'd appreciate it. So okay, so here's a, yeah.
Just a quick comment related to what was saying. So
yeah.
one of, I guess because you gave the example of China, right? And then there's the case of the US legislation that requires basically CBDC pays interest. But in China's case, it pays 0 interest. And one of the points in the debate is actually CBDC should not affect financial intermediation. And in your model, it obviously affects financial intermediation.
Obviously,
so,
yes.
Yeah. So how do you see this then?
I mean, I think this is the first order question. I think a lot of reluctance of the central banks in offering this is not to mess around with the commercial banks. And I do get the point that the commercial banks are more stable if they are richer. However, it does affect monetary policy. If you think about let's say the Fed fund rate, the Fed fund rate is sort of always below, right? Almost always below the IOER. So when the central bank moves around monetary policy by varying IOER, it doesn't get passed through perfectly. So in a sense, the central bank cannot perfectly control the effective monetary policy if the large banks start to have this market power. So I do think it is a viable sort of consideration to think about whether there is a scope to offer a bit of interest rate to kind of nudge the big commercial banks not to exercise their market power to the full extent. Another way of saying is that the 0 rate is a corner solution, and we know in general the corner solution is unlikely to be the optimal solution. We are not prescribing what's the best solution, but I think it's worth studying, right? As at least academic matter. I'd be interested to see, for example, in China, I don't know if anybody have studied this. When the CBDC started experimentation in a few cities, do we have empirical studies on, how the purchase behavior, etc.? Do people seem to like it, right? Because that app is probably doesn't have the same convenience value as Alipay's convenience value. And it sort of would be interesting to see, right? Whether
a quick comments to Feng, and also check making sure that I understand your model.
Yeah.
In China's implementation, it's called a 2-layered structure, but I think that's exactly the same what you are doing here. It's just that you have different interest rates. So obviously, Beijing would like to say nothing is changing. We just wanted to experiment. Right. And once you experiment a little bit more, obviously all these opportunity costs are changing. Second layer equilibrium effect kicks in. So this is what Haoxiang's paper is doing, I feel.
Oh yeah, thank you. This is a great way of framing it. I think maybe this slippery slope is what people are worried about, but I think this may be the time we kind of consider some interest on. Anyway, so the last proposition I'm showing here is the impact of the increase in CBDC rate. So here, unfortunately, I mean, the theory can be a little ambiguous. So the comparative statics cannot be signed kind of definitively. What we can sign is that in the constrained equilibrium, right? So when the large bank, offers exactly the CBDC rate, an increase in the CBDC rate is going to reduce the small bank's market share in the deposit market. So that's this point. But the small bank's interest rate may be higher or lower, sort of depending on the distribution of functions, and also the loan qualities may be higher or lower. However, numerically, at least with simple examples, the small bank's interest rate is actually increasing, right, in the CBDC rate, right? S goes up, then RS also go up. In that case, we can also, if that's the case, indeed, we can show that the small bank's loan quality threshold also goes up and loan volume goes down. So here is a couple charts, and then I'll wrap up. Fixing the central bank rate paid to the banks, IOR, to be 2%, and we can vary the CBDC rate from 0 to 2%. Again, under the uniform distribution, we can see, I'm sorry, this is 1.5. We see that as the CBDC rate start to go up, the deposit rate, kind of both banks start to go up, and the spread start to narrow. And in addition, the small banks market share start to go down. This is because the convenience value of the large bank sort of again become dominant as the deposit spread start to shrink. And the loan quality is sort of kind of going up uniformly. The small banks loan quality, yes, going up, but pretty flat. The most change has come from the large bank, and the entire total lending volume goes down mildly, and it's mostly a reallocation from the small bank to the large bank, right? As the CBDC rate start to go up, it is the large bank that start to offer more loans rather than the small banks. And finally, we are considering a regime where the CBDC rate S is exactly half of IOR rate F. So then what happens is that in the deposit market, the large bank offer exactly S. You can see that there's a perfect alignment between the large bank's equilibrium rate and the CBDC rate. It's always binding, and the small banks sort of always have this spread, and the spread widens as the interest on reserve start to get higher. Because the spread widens, we can see the small bank gains market share if the rate start to go up, right? So in this kind of environment where CBDC rate is proportional to the IOR, small banks tend to benefit as overall rate start to go up. And the same thing for lending, you can see that the small bank tend to benefit as the total rate start to go up because the lending volume kind of gradually shift to the small bank. So you can see basically the proportional CBDC rate and sort of a fixed CBDC rate have quite different implications. So let me wrap up. This is the model, as you can see, is still early stage work of heterogeneous banks that have market power in the deposit market and in the lending market. Most of the action happen in the competition of the deposit market. We show that the higher interest and reserve generally increase deposit rate, reduce the total lending, and increase the small banks market share. And a higher IOR can also increase small banks lending, which in a sense is sort of maybe a little surprising result, right? This is where heterogeneous banks model really matters because of this reallocation from small bank to large bank. Interest-bearing CBDC generally reduces the market share of small banks, but at least in the theory, we cannot assign its impact on the deposit rate and loan volume. The trade-off, I guess, in the broad picture of CBDC is the sort of familiar one of quality versus quantity. By increasing the rate, doesn't matter which rate, IOR or CBDC rate, we would see some reduction of lending, but the loan quality would be better, right? So that's the sense in which how much the central bank wants to so temper the heated economy versus stimulate the economy. And finally, I think we touch on this. If you ask the question, what's the best CBDC rate in the range of 0 and F, it is our opinion that the corner solution is unlikely to be optimal. Namely, if you narrowly want to just introduce a CBDC, just replace physical cash, I think it's probably not the optimal solution in general. It could be small, but I think we sort of probably need to study more on this. I think that's kind of an interesting question of what is the right design of CBDC. So that is it. Thanks a lot for the discussion. I'll be happy to discuss more.
Thank you, Haoxiang. That was great. So I think the floor is open for discussions. Questions, please.
Haoxiang, so the usual question about this type of model is the real side versus the monetary side. I know that you're not touching anything on those sides. I just would like to know that in what sense. I mean, all these things that I feel like this is like a fountain pen type of idea. Is saying, I can create a deposits, I can create a loan by deposits, all these things, and then real side kicks in to constrain that power. And can you say a little bit along that side what's the role of the CBDC on this field?
On the real side, I mean, the real side we have I guess primarily is the credit market. So the credit provision, that's sort of the real side in our model. It is this kind of fountain pen type of a model, right? The bank could create a deposit, just write it. I guess maybe in the innovation.
Let me clarify. So
yeah.
In the model seems like the reserve is something drained from the real economy, if I understand correctly, because the central bank hold it reserve, and those things are not going to the real loan, and this is where the margin is moving around.
Oh, so yes, no, right. I mean,
but in practice, you see that all these things essentially within the banking system or just numbers, and it's very hard to imagine that this reserve, interest reserve, raise the rates high, like getting more money into the reserve, saving the reserve. This is driven by the IOER, and then you immediately drain from the real side to the central, whatever central bank is holding. It's not clear in that market.
No, right. So if I understand you correctly, so the reserve in our model, at least the stock reserve, the X in the very beginning, is not related to lending really. I mean, in a sense, the lending is only determined by the profit from lending, right, and opportunity cost, but not really by the amount of reserves. So even if you have a huge amount of reserve, doesn't mean that you're going to lend a lot. I don't know if I get this right. Get what you're asking.
Mm-hmm.
So Rod, you should jump in if you like.
Yeah, no, it's a really good question. But we are just, we're not really formally modeling the real side, but I mean, this can be done. If you look at Andel Fato's paper, he builds in this overlapping generations framework.
Oh, okay.
And,
he does.
And our model is sort of a slice in some sense of that's sort of ignoring the real side. But what Haoxiang was just saying is, reserves are not really fundamental here in the sense that we're just assuming they're abundant. And the lending criteria, the amount of lending in the system is not in any way determined by the level of reserves. We started off with saying reserves were equal to deposits, so essentially, I guess, a narrow bank. But we didn't need to do that because we don't have any reserve requirements in the model. So all we were really doing in the initial setup is we're ultimately using that lending relationship story. So we wanted to have there to be depositors that were in the same proportions as the ultimate sort of steady state that we have in mind. But it's not that we're sort of creating something out of nothing. The reserve levels are really not that relevant, again, because we're ignoring reserve requirements or because we are assuming, as is the case, that reserves are abundant. And real value is created by the existence of these productive borrowing opportunities. And so I do agree with you that we are ignoring the real side, but I think one can build the real side into this exact model.
I guess more interesting question. I understand that just people do that. The CBDC. What's the role of CBDC in this thinking along these lines? It's helping this for the real side is more responsive to the central bank system or not? Yeah. You had a little bit discussion on those.
So the overall theme here is that everything goes through the deposit channel, right? Because the competition deposit sort of affects the lending and etc. Give the large bank the advantage. The CBDC plays the role of sort of constraining the market power of the large bank. Now, we have not specified any objective function of monetary authority. For example, I mean, the question is, if you get a lot of delinquency loans, because the large bank just have such a low quality threshold, one could imagine that the CBDC would be quite helpful here by reducing the default and the risk in the banking system. But we have not, put in the explicit objective function. What we did just to spell out all the different aspects of it, right? The interest rate, the market share, the loan volume, loan quality, etc. I think the point is that maybe a monetary authority would look at this kind of model and say, well, which part do I care about, and sort of pay more attention to that part. Rod, do you have any?
Yeah, no, we are certainly ultimately interested in thinking about optimal policy, but one thing that central banks are interested in is just the what if. That is, if we introduced a CBDC with an interest rate, what would be the impact? And so at this level, we're answering that question. But of course, the next step is to think more seriously, as Haoxiang does in the final bullet point. What would that optimal rate be? Yeah, absolutely.
So in a way, so we know that the central banks have these, say, electronic reserves for a long time, right? And then basically, and then we have all this digital money in terms of digital wallet and other forms of digital payments. So basically, you don't really need a CBDC if you're just substituting M0, right? And the reserves, precisely, it is just the digital money. You can regulate with IOR or IOER, that would be fine. And then if it is the case that, say, in the case that the individuals, households, they can open an account with the central bank and then have this digital currency directly connected to the central bank, then why do you need the banks? You can just have the deposits with the central bank, right? And then it pays you the deposit rate. So what's the role here, the financial institutions and the central bank?
So let me have a quick go on this one. So the banks in our model, they determine which projects to lend to, right? So credit provision is still with the commercial banks. I think that's important. And in terms of deposit market, remember the CBDC rate is a really policy variable that you can choose to be high or low. If that rate is not close to IOER, then the commercial banks still play a pretty important role there. A lot of deposits still go to the large bank, and in fact, all it does primarily, I guess, right now is to put a new floor on the deposit rate. So the CBDC does have an active role in the model, and depending on how we model it, right, one could make it more stringent or kind of more aggressive versus more passive.
I think we have a few questions in the chat.
Right. Yeah, I see Daryl's earlier question about narrow bank. Yes.
And then from Zeyuan. China uses CBDC to substitute M0, hence no interest bearing. So what's the main policy considerations of central banks who are going to apply interest bearing CBDC?
Yeah, that's a great question, right? So I guess let me just say what our model says, right? So if the central bank pays interest on digital currency, it has impact on, number one, the deposit rate itself, therefore the welfare of depositors. That's number one. Second, the market share of the big and the small banks, right? Think about the competitive landscape, whether you want to support kind of smaller players. And number three, what is the quantity and the quality of the bank's loan book? So all of this, our model have something to say about. Maybe the main risk is sort of, one thing we did not really catch sort of the total aggregate, say, profit of the banking sector, which I assume, given that the total loan volume goes down, might be going down a little. But I think this is, one of kind of classical kind of debate between what's the kind of stability or kind of safety or kind of the equity building of a banking sector versus sort of the risk and also the welfare of the depositors. Rod, do you have anything on that?
Yeah, no, I agree with all that, of course, and also, I'd go back to what I said earlier about that. The central banks want to understand what the implications would be of a interest-bearing CBDC, whether they implement one or not. And there are also other reasons, remember, that are outside the model why banks might entertain introducing CBDC. They might be, as cash declines, there's no alternative way to pay that provides privacy from the commercial sector. So they may be thinking about introducing a CBDC as a way to provide this privacy. And if they want people to use it, they may need to, allow it to have some type of positive interest. And so I think there's lots of reasons to at least consider the implications of an interest-bearing CBDC, and I can think of multiple reasons why they would. Also, going back to the idea about the deposit market. So, in the United States, at least, the deposit rates do not get bid up all the way to IOER. And so there is sort of some question as to whether or not, so this market doesn't appear to be perfectly competitive. And so there is some question as to whether or not there's a policy role for the central bank in influencing this market, and considering interest-bearing CBDC as just one such tool. But
thank you. Yeah. So I think we are just on time now. Any further questions that you want to put to the speakers? This is probably we can last opportunity.
Yeah, we can also kind of discuss offline as well. However, if you have any suggestions and comments, or especially if you have relevant work, we are also in the process of. Certainly, you can see the literature is kind of short. So we are also kind of looking more into this. The China experience, I think, would be quite interesting, as I mentioned before. It is a leader in the creation of CBDC. Yeah, and the Luohan
too.
Yeah, I think if Luohan Academy has a view about CBDC offered by the PBOC, feel free to. Yeah, maybe we should discuss this offline if you don't want to broadcast.
Yes. Yeah, we will have opportunities to discuss. But
okay.
I think this is great. I think we will learn a lot from the talk by Haoxiang and by Rod. I think going forward, we probably have more things that we need to know. And this is going to be a game-changing event when more and more central banks adopt digital currencies. Thank you very much. This was very helpful.
Thank you very much, everyone, for the comments and the discussion. And thank you for hosting me. It's been a real pleasure.
Thank you.
Okay, great. Bye now.